Index investing, the basics. Before we get stuck into the video, I want to touch on some fundamentals that you need before even considering index investing into the stock market. Concentrate on your personal finances first. Spend less than you earn, and then you can invest. Build a cash buffer of 3 to 6 months living expenses. Read the books like The Little Book of Common Sense Investing by John Bogle. Dollar cost average each month and long-term buy and hold. And ignore the noise. Check your fund once or twice a year. If this sounds confusing, don't worry. We're going to cover the basics so you fully understand index investing. Today's video will be covering what exactly is an index fund, the lingo, the basic terminology you really need to know, the importance of your risk tolerance, and how to actually buy your index fund. Then I'll finish with how I've been investing in index funds over the last few years. Right then, what is an index fund? An index measures companies within the stock market. For example, a UK index is the FTSE 100, and this tracks the 100 best performing companies in the UK. A popular US index is the S&P 500, and this tracks the 500 top companies in the US. An index fund is where a large number of investors pool their money together into one fund that is looked after by the fund manager. I invest via Vanguard, so the fund is managed by Vanguard. The fund manager looks to match a particular index, like the FTSE 100 or the S&P 500. Your fund has a small slice of several companies, so your risk is reduced or spread out. This is safer than investing in one stock. Now, index funds are usually made up of a mix of stocks and bonds. A very popular split has been 60-40, which is 60% stocks and 40% bonds. Index funds are passive and good for hands-off investing. They have low fees, and this is something to focus on when you come to picking your index fund. Before we go any further, I just want to stress the importance of personal finance. So I've done a few videos recently on personal finance. Check out the video description for my latest personal finance video. Get an overview of your personal finances, and then you can invest. Then you can invest in index funds. Anyway, moving on to the lingo and the basic terminology you need to get into your head before index investing. Bonds. This is where you make a payment, like a loan, to a large organisation, like a government, for example. So if you get a UK government bonds, you're giving the British government a loan, and they pay you interest on that loan. The interest depends on what bonds you invest into. Compound interest is basically interest on top of interest, and is really worth understanding, as it will make you a fortune if you invest for long periods. Index investing was made famous by John Bogle, who's the founder of Vanguard. This is where you track the stock market. You have a small slice of several companies within your fund, as I've touched on. The costs are low. Mutual funds are different because you have a small slice of several companies within your fund, but your fund is managed by a fund manager who tries to beat the market, not match the market. And there can be high costs associated with mutual funds, so just bear this in mind. Transaction costs. These are normally hidden charges that we all need to be aware of. Basically, read the small print. Shares. The stock of the company is sold in units called shares. A share is a unit of ownership or equity in a company or corporation. Stocks, shares, and equities are basically the same thing. Look, there's quite a bit to learn when you first start index investing. So check out the video description. There's some useful books I've recommended that will help you fully understand index investing. Then you can invest. We're now going to touch on your risk tolerance. As you can see, we have high risk and low risk. So when you look at emerging markets, they're seen as very high risk. Then you have Japanese equities, European equities, US equities, and UK equities. And these are about in the middle of the road. Reducing your risk, you start looking at property, corporate bonds, and very low risk is gilts. If you speak to a financial advisor, this is something they'll go over, they'll cover in detail. Do your own research, but I would also speak to a financial advisor before you start investing. If you're in your early 20s and are planning on investing for the next 30 years, you can afford to go high risk and ride the inevitable ups and downs of the market. If you're in your 50s and have some serious money behind you, serious money built up, you're going to be thinking preservation and you're going to be thinking low risk. So early 20s, you might think 100% shares, and in your 50s, you might think a bit safer 50-50 split of shares and bonds to reduce your risk. But how do you buy or pay into your index fund? You do this with a platform like Vanguard or Hargreaves and Lansdown, for example. A platform is where you can choose your index fund and you can add money to the index fund. The platforms I'm most familiar with are Fidelity, Hargreaves and Lansdown, and Vanguard, but there are loads of platforms to choose from. So do some digging. Again, focusing on the costs associated with your fund and for using the platform. I started with Hargreaves and Lansdown in 2019, but moved to Vanguard later that year because the costs were lower. If you choose to go with a fund within your ISA, for example, compare funds on a fund rating site like Morningstar. Just do your own research and read books by the likes of John Bogle, Warren Buffett, Ray Dalio, Tony Robbins, Andrew Craig. These sort of books have helped me to fully understand the fundamentals. Take your time to choose your fund. Personally, I started with a Life Strategy 80-20 fund, but have recently moved to a Life Strategy 100 fund because bonds aren't very good when inflation is high. Think costs and taxes. I invest into a low-cost index fund and I'm tax efficient as I use my ISA. Whatever country you're from, learn where to put your fund. I use an ISA and SIP in the UK. Index investing has been my favourite way to invest. It removes the emotions. I've been very emotional in the past when it comes to investing and money, but not with index investing. This isn't advice, but I am trying to nudge you towards this method of investing that gets you into the stock market. It gets you into the stock market safely and is the ideal starting point before you even consider single stocks. Final words to wrap this video up. Think long term. Ignore the noise and invest into a passive index fund that takes away any stress other investing methods can sometimes bring. That'll do for today's video. If you've liked the video, if you've liked the content, give me a thumbs up. And if you've really liked the video, subscribe to the channel so I can get the content out there. I can help other investors, beginners, understand what index investing is. Thanks for listening.